What's a great use case for venture debt that founders almost never think about until like that second or third time around?
It's actually a fantastic tool to negotiate higher equity valuations.
Ooh. When shouldn't you raise venture debt?
When you don't have product market fit, when you don't have a plan to be able to repay the debt.
That's a good one. Yeah.
You would think that that's kind of obvious, right, to a company, but it hasn't.
You have to say it.
It hasn't necessarily been the case. I'm constantly focused on pipeline development and relationship building, as opposed to just like relying on my existing relationships. I still cold call consistently.
Really? You do?
Yeah.
You're a managing director and you still cold call.
Oh my goodness. Absolutely. I still cold call. I still cold email. I actually block it out on my calendar throughout the week. Uninterrupted time.
Are you just worried you're going to lose your edge? You're like, I need somebody to hang up on me.
Perhaps, yeah. I mean, it's
I love this. This is awesome. Is this thing on?
Yesterday's price is not today's price.
Welcome back to the show. Today, we're diving into the world of venture debt in 2025, a space that's evolved dramatically from just a couple of years ago. Yeah, and one that every CFO should be paying a lot more attention to. Our guest, Jhung, has built a standout career in venture lending and started out in sales, actually, which turns out to be great training for selling, the one thing that every company needs, capital, selling capital. We'll unpack the questions CFOs should be asking their banks today, the trade-offs between rate and flexibility, and the one use case for venture debt that founders almost never think about, but absolutely should. Then we zoom out to the market itself. Who's playing offense in the venture debt landscape right now? What's the real difference between banks and private debt funds? And why are funds suddenly eating more of the pie? If you're a CFO weighing your options, what's the biggest non-obvious trade-off that can swing your decision? And we'll also dig into the tension and cooperation between VCs and venture debt providers. This part's juicy. And how savvy CFOs are managing their banking relationships with surgical precision. Spoiler alert, not all chips are created equal there. And knowing which one your bank values most could save you millions or cost you optionality down the line. And finally, we zoom out even further to talk about capital as a commodity and how the best people in the space differentiate themselves when the product is, well, money. Jhung from Hercules, one of the brightest in the venture debt biz. All this and much, much more after a short word from our sponsors. Hey, Metrics fans, let me ask you something. Do you know what keeps CFOs and finance teams up at night? Well, it's not the complex analyses or forecasting models. It's the mind-numbing tasks of chasing receipts, reconciling expenses, and juggling 5 different systems just to track company spending. I was talking with a finance leader last week who calculated her team was spending an astonishing 20 hours weekly just on expense administration. That's nearly 1,000 hours annually on low-value tasks. That's why I'm excited to tell you about Rippling Spend. Rippling Spend is the only platform that automatically handles your entire company's spending in one unified system. What makes it different? It's built on Rippling's workforce platform. So when org changes happen, like someone getting promoted or changing departments, all approval workflows, access permissions, and policies update automatically. Picture this. When your marketing director goes on vacation, expense approvals don't sit in their inbox waiting for their return. Instead, they're automatically routed to the right backup approver. No manual delegation needed. Meanwhile, your finance team gets real-time visibility into all company spending with no more month-end surprises. As a Run the Numbers listener, you can get an exclusive demo showing exactly how much time your org would save. Just visit rippling.com/metrics to learn more. That's rippling.com/metrics. Do it, guys. As a CFO, you're expected to bring clarity to everything, including how your company manages ownership. The tools you use should make that easier, not harder. But when they come with hidden fees, data you can't always trust, and support you can't rely on, you end up with more frustration than clarity. That's where Pulley comes in. Pulley is the cap table management platform built for finance leaders who need accurate, decision-ready data from a system that works for your business, not against it. With Pulley, you get intuitive workflows, audit-ready reporting, and support you can count on, all backed by predictable pricing you can plan around, so you can stay compliant and make smarter decisions about your company's future. Manage everything from fundraise modeling to ASC 718 reporting to custom liquidity programs, all on one trusted platform. Hundreds of high-growth companies like Linear, Fathom, and Runway trust Pulley to help turn ownership into a strategic advantage. And joining them is now easier than ever. You can switch to Pulley in as little as 5 days. And for a limited time, they're offering 25% off your first year. To claim your exclusive offer, visit pulley.com/mostlymetrics. That is pulley.com/mostlymetrics. Pulley.com/mostlymetrics. Here's a question. When was the last time you really had time to focus on growth and not chasing contract renewals, tracking shadow IT spend, or explaining rising software costs to the board? Yikes. The truth is, traditional spend management is broken. If you're still piecing together data from 5 different systems just to figure out what you're actually spending, while vendors keep on pushing those auto renewals and price hikes, my friend, I got a solution for you. That's where Tropic comes in. Tropic is an intelligent spend management solution that consolidates your spend data and processes into one unified offering, enabling insights and decisive action. It doesn't just show you where the problems are, it helps you solve them. From spotting hidden optimization opportunities like duplicative spend, to automating those painful procurement workflows, to giving you the best market data that turns every vendor negotiation in your favor. Tropic combines smart insights with real human expertise to keep you ahead of the curve. And I can say firsthand because I've used them for over 2 years. Their SaaS platform helps me with price checks. It helps me keep my calendar organized of when renewals are coming up and I can actually visualize it. And let me say, it saves me more than 10 hours a week on vendor management, and we've saved a ton on renewals. I'm walking into the boardroom with a lot more confidence. Isn't it time to turn your spend management into your competitive advantage? Visit tropicapp.io/mostlymetrics. That's tropicapp.io/mostlymetrics. CJ, welcome to the show. You're the first CJ I've ever had.
I think, you're maybe the first CJ that I've met as well.
Yeah, I don't think your name's Carl though, is it?
No, it's not. No.
Well, I'm pumped for this because I look at it kind of like a state of the venture debt market in 2025. And I was lucky to have my buddy and your colleague, Ruslan Sergeyev, which I probably butchered his name, but cool dude. He came on the show about a year ago, and he went deep with me on just how the venture market works and, you know, the things that a first-time CFO should keep their eye out for. And I feel like just keeping up with you on LinkedIn, we've been doing this dance where we're always exchanging posts and stuff. I'm keeping up with your stuff, but now I'm finally going to get the lowdown on what's going on in this crazy world.
Happy to be here. Thanks, TJ.
What's one question CFOs should be asking their lenders today that they weren't asking 18 months ago?
I don't know if it's so much like if much has changed between now and 18 months ago, but I think a key thing, and I'm seeing this both across like both debt and equity, is it's just like how they have worked through their companies through the tough times and just broadly understanding their commitment to venture debt as an asset class.
Yeah.
And I guess so it's in a lot of different pieces. And I think this is where CFOs should do their homework around this, and like they're more apt and kind of well positioned to do this more than anyone else. But in our case, we're a public BDC. So you can see very clearly like what our cash position is, what our funded commitments are, what our unfunded commitments are. And there are a number of funds that are out there that are kind of flip-flopped in terms of there's a high degree of unfunded commitments relative to cash on their balance sheet, which can become problematic in the case that a lot of the portfolio wants to draw down on commitments, things like that. And then also just a track record of being supportive of portfolio companies through the tough times and like how they handle it and like what types of companies and what type of role they play during those times. Because I mean, when businesses are going well and people are hitting plan, because everyone hits plan, it's never an issue. But in the cases where things, where there are bumps in the road, that's where it's really important to have a really good sense for how your lender is going to behave.
In the whole concept of hitting plan, there's this funny dynamic of when you're raising money from a VC, you want to shoot for the moon and give a more aggressive plan so you can get a higher valuation underwritten. But That's a really dangerous game to play with a lender, because if you give them too aggressive of a plan, like you can get tripped up pretty easily.
For sure. It's a great point. And when we do talk with prospective portfolio companies, like, I mean, there's oftentimes like the really experienced CFOs, they have like 3 plans, right? They've got
Exactly. Say more about this. This is like the inside baseball.
Because you've got like the fundraising plan,
right?
And like, don't send me the fundraising plan, and then you've got like the plan that you present to your, to the sales team, and to the company for like, let's go for this plan. This is like the goal, and then you have like the downside plan where, okay, worst case scenario, like we can guarantee hitting these numbers, and which is how you're kind of managing too on the budget side, where if you don't hit this, then cuts probably need to happen. It's like, show your lenders like that worst case scenario plan or the one that you can guarantee, because like that's what we'd want to structure off of, as opposed to like the rocket ship plan.
That's sage advice. And it was almost something that I tripped over when we were looking into taking out venture debt, because I was like, a lot of times it comes along with a fundraise. I was like, I just raised a Series C. This is a great time to go out and just open up a facility in case we need it. And I was like about to give the super aggressive plan that we just raised that off. I'm like, whoa. I don't want to get over my skis here.
Yep. So how many plans did you have in that case?
We had 3 plans. So we had we had the board plan that everybody's bonus was based off of, and it was linked to the executive team. And that had like a cost structure that we knew was okay if our revenue targets like came in a bit light. Then if you went up about 15%, you had what we gave out as quota to our reps.
Yep.
And that amount gave us some leadway just in case bad macroeconomic conditions, big deals push, attrition, a major leader leaves. Like you need a little bit of runway or like reps ramping up the speed. Then you go maybe 10, 15, depends on the year. Back in 2021, maybe it's 30% up. But then you have the other plan that you raise money off of. And that one has a pretty aggressive next 12-month revenue plan. And of course, no matter how small you are, you could be doing 1 million in revenue. It's going to say you're at 100 million in year 5.
Yep, exactly. So I'm always surprised when folks like don't necessarily start with that plan, but I understand if you're on like kind of the track or like that motion of like constantly fundraising, then I get why you'd want to start with that pitch. But then it's best to just start with like the honest truth from like the first call that we have from that first interaction, as opposed to like we start here and then we start chipping away and it goes in a different direction. So it's
totally.
It's different with credit.
And it all, I think, goes back to what you're trying to maximize for. Like, what type of optionality do you want here? And, like there's the old adage that you try to optimize for the fundraise, but then maximize for the sale, because you only have one sale, but like you don't want to like totally get a valuation that you can't keep up with if it's just like your Series C and there's a long way to go. But I think like it's a different game that you're trying to optimize for when you're working with a lender, right? So, I mean, like there are different levers, and I kind of square them as like rate and flexibility, but I don't know how you look at the different levers in your mind that are there to play with.
So tying this to what we were just talking about with hitting plan, I think this is where it comes into play, especially, and I'm going to speak from the Hercules perspective, because we're a team of investors and not necessarily operators. And so we don't have the team that is going to come in and run the business in a special situation. And so with that, we want as little headache as possible with the portfolio. Whereas, some investors, it's like they have that's like a part of the DNA and that's part of the ecosystem. I'm sorry, not the ecosystem, but that's part of like their, just like the DNA of the fund. And so with that, because we typically have no financial covenants with our term loans, and they're typically bullet structures, meaning that they're interest only for the life of the loan, we have very, very flexible debt facilities. And so with that, when we're structuring our debt facilities, so we're wanting the companies to hit as close to plan because we don't necessarily have a lot of structure in the deal. And that's a benefit to the portfolio company, because we are allowing them, we're allowing them to like operate and run their business without all sorts of restrictions. But there's give and take there. And so with that, because of that, we are targeting companies that have a great like track record of growth, that have healthy KPIs, so that we don't have to charge a lot, so that we're not in the high teens, so that we don't have a lot of covenants, so that it's kind of that like Goldilocks pricing of pricing and flexibility. And so the other thing that's another, I think, difference with us when when talking about price and flexibility is that for a lot of these types of companies, because we're typically working with later stage venture-backed companies, so typically Series C and beyond, they can also have bank debt as well. And so it's a great way for the CFOs or for the companies to kind of optimize their debt structures. Oftentimes is where, you want to max out where your bank will get to from a leverage standpoint and not have covenants and structure because the dollar amount is smaller. And then we could sit behind them with with our term loan to get to whatever the target dollar amount is without the structure. And then when you have like the blended cost of capital, that's where it's really a win for the company.
Hey, thanks for listening. We'll be right back after a word from our sponsors. What does the future hold for business? Ask 9 experts and you'll get 10 answers. Bull market, bear market. Rates will rise, rates will fall. Can someone please just invent a crystal ball already? Until then, over 40,000 businesses have future-proofed their companies with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. Whether you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. If you listen to this podcast, you'll know I ask CFOs all the time to rep their tech stacks, and I would say almost every one of them use NetSuite. And that's what I would use too. Whether you're a company earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/metrics. The guide is free to you. That is netsuite.com/metrics. Ooh, yeah, it's netsuite.com/metrics. Please, guys, I really need this. Ready to plan confidently, close faster, and report with accuracy? Here's what sets Planful apart. Imagine purpose-built solutions for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks with minimal IT involvement, enabling seamless collaboration across your organization's key financial workflows. Best of all, Planful grows with you. Its unmatched scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Visit planful.com/metrics to see how you can elevate your team this year with Planful. They will hook you up. It is planful.com/metrics. Tell them your boy CJ sent you. Planful.com/metrics. If you're a CFO trying to keep up with usage-based billing, complex contracts, and a finance team drowning in spreadsheets, listen up. Meet Tabs. Tabs is the AI-native platform automating contract to revenue for finance teams that are scaling fast. Whether you're selling custom terms, usage-based pricing, or a mix of PLG and sales-led, been there, Tabs turns month-end chaos into clean cash flow. It's like having a controller that never sleeps and a billing analyst who actually understands your pricing model. No more manual reconciliations, no more late-night close deadlines, just clean data from contract to cash. It used to drive me nuts that we do all the work to close the books inside our ERP in our FP&A tool, and then we had to export the most important part, revenue, to this janky spreadsheet and manually calculate what we did that period. And don't even get me started on the back of the envelope calcs we did to get to ARR based on all the unique contract terms we had floating around. Our investors would wince if they knew. Let's be honest, legacy systems here are not going to cut it, folks. Tabs is the system I wish I had in my CFO days. Fast-growing companies like Cortex, StatSig, Cursor, and others are already using Tabs to instantly generate invoices from any contract, automate RevRec, cash application, and get finance out of manual mode. If you want to automate the mess and fix the way money enters the building, baby, go check out tabs.inc/metrics. Again, that is tabs.inc/metrics. And if your team's still closing the books like it's 2015, now's a good time to upgrade. That's really amazing. And stupid question, when you say you sit behind them, that's just like in the capital stack of who gets paid first in a downside scenario for the benefit of listeners?
Exactly. Yes. So you have like the senior lender,
Yep.
and then you have like the second lien lender, or like it's also called like the mezzanine, like mezz debt that sits behind the senior facility.
Maybe just for a sec, we can pause and talk about how Hercules is different than like a bank, because you mentioned you're an investor and you also threw around the term BDC, which I wrote down, and I'm going to be the one on the podcast who asks the stupid questions of what that means.
So that stands for Business Development Corporation.
That's what I saw on Wikipedia at 2 a.m. last night preparing for this podcast.
Okay, so Hercules, we have our main public BDC. And then in addition to that, we also have 3 private credit funds as well. And really the benefit of being a BDC is that you can kind of think of us as like an evergreen fund. And given that we have consistently traded above book value, it makes it really easy for us to raise additional capital when need be. And then we've only kind of solidified our balance sheet with 3 private credit funds. That helps us get even more flexibility to do deals outside the US, to work with public companies, which is actually a big part of our portfolio. On the life sciences side on the business, I co-lead our tech practice, but the life sciences side, they do a lot of public companies. And then there are also just like restrictions that we have as a BDC in terms of the types of companies that we can lend to. So for example, like broker dealers, it's hard to lend to lenders, but with our private funds, we could do all those deals. And so we're not limited. And then getting back to your question about how we're different from banks. So, I mean, we don't hold deposits. And so what's really helpful for our portfolio companies is that, they can choose to bank with whoever they want, and whoever's going to be the best, how to optimize their cash and deposits and their banking relationships given their needs. And so that just gives them just even more flexibility. And then banks ultimately, depending upon the stage of the company, they have different kind of goals for getting kind of like the banking services and like the credit cards, or maybe it's like taking the company public. So there are different kind of revenue centers within a bank that they're chasing after, but ultimately like lending to like cash burning technology companies, I wouldn't say is like, yay, let's go do this, because from an IRR perspective, like that's not their ultimate goal. Whereas with us, we have like one thing that we do and that we do really well, and it's lending to these companies, and we're not focused on anything else other than that.
That was such a great explanation. And it was one of the things I was hoping to tease out of this podcast, because a lot of times people talk about debt like it's just this one big bucket, especially if you're a technology company. Like, what's your capital stack? How much of it is debt? But it's really important to know the incentives in the games that the people who are giving you the money are playing, right? Because VCs have one game in mind, Bank of America or, a Dedham Savings Bank where my grandma banks, like that's a different game that they're playing. And Hercules, for you, like you said, you're an investor. That's a different incentive structure in a different game that you've chosen to play.
Yes, it's very niche, the market that we're playing. And then even within like a niche market, we're really focused on a very specific type of company in terms of stage and growth rate. And
it positions you to actually work with some of the more exciting companies that are out there right now, because if I have it right, if you're like Series C, I have a certain scale in mind, a lot of those companies are on a road to be an IPO company someday and make that crossover.
Absolutely. I mean, that's really like our target portfolio company are the fast, exciting growers. We also tend to work with a lot of like second, third time founders who really kind of value like ownership of their businesses and
not getting diluted.
And yes,
you learn that by your second time around.
Yeah, and using debt as a good tool as they're growing their businesses, where it's a balance between the two.
What's a great use case for venture debt that founders almost never think about until like that second or third time around?
It's actually a fantastic tool to negotiate higher equity valuations.
Ooh, can you break that down? That's hard.
And it's happened a number of times in our portfolio. So when you have cash on your balance sheet, or in some cases, because we'll do delayed draw term loans, meaning that we meaning that a company has access to the capital, and we do have our companies draw down a portion of it at close, but then a portion of it can be funded through, at a later date when they, if and when they need it. And having that access to the capital or already the cash on the balance sheet, I mean, when you're negotiating with, your prospective equity investors, you're not lying when you're saying that, we don't have to raise right now. And they're ultimately deciding if they want to draw down on the debt facility or if they want to raise additional equity. But of course, the equity investors are delivering a lot of like value add to the company as well. But when it comes down to just like purely financials, it's like, and folks know within the industry that we're that we're very selective about the companies that we lend to, and that we didn't put a lot of structure in. So we have a lot of conviction for the company, and that we can continue to write larger and larger checks to the companies, that it puts the company in a position of power when they are negotiating.
With that being said, how much debt is appropriate for a capital stack these days? Like, is there a size or a range that like companies are honing in on?
That's a great question. And so that's one thing and also getting back to kind of the differences between banks and funds or with us. So banks, what typically happens in the cadence is like you raise equity, and then the banks want to get those deposits. And then once they have those deposits, then at that point they will lend or they'll put a debt facility in place for the company, right, when they raise equity. And they tend to be shorter term facilities, whether it's like 2 to 3 years. They'll do credit lines or term loans. With us, and that's a great use case with the banks, and their cost of capital, it's really cheap. It's like prime as an example. And then for us, we're typically coming in between equity rounds and then giving companies like that meaningful runway extension or helping them finance M&A or it just depends upon what, or that maybe we're helping them with like inorganic growth, or organic growth in a certain region. So the use cases are different. And so our underwrite is based on the enterprise value of the company, as opposed to a bank, which is underwriting the cash balance of the company. Because we may be funding into situations where cash is actually not very strong, but the KPIs are off the charts. And we're fine leaning into this, even though the cash has limited liquidity, because we feel confident in the company's ability to, number one, continue growing with us until their liquidity event or their ability to raise an equity round. And so in terms of the metrics and like how we evaluate what the right amount of debt is, it's really it's company by company, and it's not like a formulaic thing. And because we lend to all different sorts of tech companies. So from software companies that have annual, recurring revenue kind of business models versus some that have transactional based revenue versus a consumer focused marketplace or a 3-sided marketplace to a deep tech company. So and each one has a different set of KPIs that we measure. And then from there, we determine like what the right amount of debt will be.
Well, what's neat about hearing that explanation is you're not just trying to fit a square peg into a round hole. And what I mean is like shove every company into this one box to evaluate it. Like you have to step back and be like, what metrics are important to a marketplace business? What metrics are important to a fintech business? What metrics mean success in like an annual prepaid software business? Because it's not just about the amount of cash you have on hand. It's how successful do I think this is going to be? And it's all predicated on the enterprise value. So I guess I'm kind of figuring out the answer to my own question in the sense that like not every capital stack is going to look the same because they have different metrics.
It's so different. And then even within like a capital stack and a type of company, and you've written, CJ, about this a lot, is just on the definition of ARR.
Yeah.
I think you published one where I think it was by company and how they define ARR.
It's like 25 companies, 15 different ways to do it.
It literally, so even like something as like, you would think, wow, it's like a no-brainer to lend to a SaaS company because their ARR is this. So it should be at, I don't know, 1 times ARR. But like, what is ARR for that particular company and how are they defining it? Is it CAR? Mm-hmm. Is it live ARR, like what is it? What does it actually mean, and what's being included in that? And that's where it's really on a company by company basis where we dig in.
Yeah. Dedham Savings Bank never asked my grandma for her ARR definition. So it makes sense though, because you are investors at the end of the day, right? You're not a bank in that sense.
That's correct.
When shouldn't you raise venture debt?
When you don't have product market fit, when you don't have a plan to be able to repay the debt.
That's a good one. Yeah.
You would think that that's kind of obvious, right, to a company, but it hasn't.
You have to say it.
It hasn't necessarily been the case. When you don't have very strong confidence in your plan, you should not raise debt. And ideally more cash on your balance sheet is helpful. Like, it's always best to raise debt when you don't need it.
I know. I always hear that, but there are people probably driving to work right now nodding their heads and be like, I don't need it right now, but it feels like a lot of work to go and get it.
Yeah, and it's one of these things where I don't know if it takes as much time as like an equity round, but it's not great when, like, it's much better to go raise debt when you have like over a year of cash on your balance sheet versus when you have like a month or 2 months of cash on your balance sheet. It's not to say that we won't lend to those companies, but I do scratch my head thinking of like, well, why did you wait so long? Like, why weren't you thinking about this earlier? And we want to work with CFOs and companies that have been thoughtful about their cash management if we're going to be leaning in and working with them.
And I'd imagine that you have multi-time CFOs who step into a new gig, and one of the rocks that they overturn when they're checking on how the business is doing is, what's the capital stack? And then they probably come back and say, well, I have a relationship with CJ and we should probably open a facility now.
Yes, we get brought in a lot when there's like a change, and like oftentimes when there's a new CEO that comes in because they want to like beef up the balance sheet. Sometimes they put equity, a lot of times that's when equity investors also come in. But yeah, it's a good inflection point in the business where we often engage with companies.
So a lot's changed since the whole debacle with SVB. We're sitting here in the first quarter of 2025. Who are the major players in the venture debt landscape today?
On the banking side or on the fund side?
Can we do both? You can take it in either way you want.
Sure. I think the biggest change has been on the banking side.
Okay.
So at least before the bank run at SVB, it felt to me that they had like perhaps 80% market share of like venture-backed businesses here in the States, and then in like Europe. But now it's really, it feels like it's spread across like a lot of different banks now, where you've got folks like JP Morgan, who, well, they've already been in the space, but I think they've definitely benefited a lot from the deposits during that situation. And then you've got like Stifel and HSBC and MUFG and CIBC. So there are just like more banks with like great people and great bankers that are in the market today that are spread across a lot of different banks, which is interesting because I think it gives companies just a lot of options in terms of like who they want to work with, because the SVB team was always fantastic.
Yeah.
And, a lot of them are still there, but a lot of those great team members are also at some of those other banks now.
And then on the side of the market that your team plays in, has that changed a lot, or is it the usual suspects?
It's interesting. So we see like some of like the large kind of asset managers kind of like come in and out of the market. We've seen this kind of happen over the years, but I think it's just getting more focused again, as the market hasn't been as active from like an IPO perspective. And I think the folks that have been committed to the space for a while are just they're leaning in even more. And then after going through some difficult times in some other funds portfolios, I think it's just like thinning. What's the term? Like culling
the herd.
I think there's been a bit of like culling the herd, where we're seeing some of the same dynamics that are happening on the equity side are going to be happening on the debt side, because not everybody has the stomach, again, to lend to cash burning technology companies.
Sure. Maybe this is a weird question. Do banks like to share with each other on deals? Like if I need to really beef up my capital stack, or is that like a territorial thing?
No, they absolutely do syndicated deals with each other to get to the quantum that the company needs.
And then what about on the fund side?
The fund side, we also will syndicate as well. So it's all about finding those great partners that are out there where it's getting back to the downside scenario when things don't go right, that they're going to be productive to work with through the ups and downs of a relationship with a business. So you want somebody super predictable.
Yes. And this is the part that I've always found really interesting. If you compare like VCs fighting for a deal where they try to take the whole thing a lot of the times, but then like what we were talking about with Ruslan is sometimes, it's 50 million up for grabs. And he says, we're going to take 25. And he calls his friend and says, hey, do you want to take 10? We're holding 25. I can't hold the whole thing. And you try to build a book with your partner. So in that sense, there's like this dynamic of like true partnership of trying to do what's right by the company and also working with others who in one sense are competitive with you, but also like you're willing to work with them and diversify your risk.
Absolutely. I think it's a win-win in many cases, especially for the very kind of large later stage venture-backed companies where I always tell them like max out your bank debt as much as you can to a point where they get to a certain quantum where they're going to have to put some structure in on the deal and then get right up to that point, and then we could sit behind them and fill in the gap. And that's really like the perfect relationship between how banks and funds can work together.
And from the outside, I wouldn't anticipate you saying that, CJ, because it's like, well, what happens if they are able to max out and they don't need us anymore? But it sounds like you're very confident in the value prop, which is cool.
Yeah, I mean, it's a possibility that the banks can do that on their own, but then it's better for the company to have a lower cost of capital working with the bank, and they shouldn't work with me at that point.
Yeah.
And so ultimately, like if I am bidding on the same deal as a bank with like the same deal structure, one of us is in the wrong room.
Oh.
Either the bank is getting way too aggressive on their structure, in which a fund should be, because I mean, our IRRs are higher than a bank's, and it should be because we're typically doing 3, 4, 5-year bullets with no financial covenants. Should a bank be doing that at potentially a high leverage multiple on a cash burning business? Probably not, because they're not getting paid for taking on the additional risk of writing a larger check without a lot of structure, whereas we are getting paid for it. And so that's where it's like, it's the balance between the two. And ultimately they are partners and not competitors.
So a bank's IRR, is that like in the mid single digits, whereas yours would be low teens or just?
Low teens. Yeah, we're low teens. Exactly.
Because in my head, I'm doing the math of like, you got the bank, then you got the funds, and then you get the VC funds who have something that's at least higher than 15%. Many of these early stage, you need to get over 30%. So you start to see like how the risk is allocated.
Yep, exactly. And that's where that's what's so fun about this, right? It's, the goal is getting these companies to grow while just like optimizing the capital structure along the way. And it's fun stuff that we love geeking out over.
If you and the bank are in the same room, I'm thinking of like that Spider-Man meme where you're both pointing at each other like, you're in the wrong room. No, you're in the wrong room.
But I think the banks have gone a lot more competitive though, because
really,
for sure. Well, because now it's like rather than 2 going after one company, now you've got like 4 or 5 potentially competing with each other.
But if you're in the same room as a VC, is somebody in the wrong room, or is that normal?
Me with a VC?
Yeah, well, there are multiple ways, I guess, to get capital. It could be a primary fundraise, or it could be taking on some debt.
Oh, for sure. That is certainly the case, where we run a pretty identical process to a growth equity investor, like a late stage investor. And oftentimes, companies can choose to go one way or the other way, or sometimes it's a blend. But they're also, I mean, they are definitely our partners on the venture side, on the venture equity side.
And I mean, VCs and venture debt firms theoretically do have the same goal, scale a great company. Where does the relationship get tense?
It gets, okay, so there's no tension when companies are performing. Okay, let's just start
Yeah,
there.
a lot of revenue cures a lot of sins, guys.
Yeah, it's all high fives then.
Yeah.
It gets tense when a company is not performing, and when either the lender or the equity investor are asked to do something that is unreasonable given the current situation of the company and not collaborating together to find a solution.
Okay.
So let me give you a specific example.
Sure.
So first off, like nobody likes surprises. And even more so, like lenders like hate surprises.
More than VCs, because I've met a couple of VCs who really hate surprises.
Oh, really? But I think they're shooting for the moon. VCs.
No,
right?
I get it. Like downside scenario is a bit different. Totally.
It's a little different. I mean, they're expected to have losses. Like we're expected to not have losses. And so that it's just a different mindset. And so, I mean, we've had a company, and it's more of like a recent example where it's like the company, didn't perform to plan, but it's like having an open conversation with the company, with the equity investors around the table of, okay, well, our debt is coming up for maturity, over the next 1 or 2 quarters, but how do we get this company to like a soft landing, right? And so given like our loan docs, like the company, we could say like, oh, well, they're in breach of like where they should be performing as a business. The worst thing we would do at that point is to go in and like sweep cash and try to recover as much as we can at that given point in time. Or it's sitting down together as a group and saying like, okay, how much cash does this company need? And how is that like sales process looking? Or maybe like, is there like an inflection point where this company can actually get back on track and we continue investing into the company? But ultimately, like, how do we get to like a soft landing? And that's where it's really important for all three to kind of come together and be flexible. And sometimes it means the equity investors have to pony up a little bit more capital. In this particular case, what we did was we just basically restructured the loan. We pushed out the amortization and the payback on the loan because we didn't want to force an unnatural business decision where everybody loses.
That's such a good way of putting it, CJ. You don't want to force an unnatural business decision because in your rights, you could come in and be like, time's up, like give us the money back. But you're still looking at it as a scenario where how can we make this better for everybody? And that does call for some collaboration with investors.
Yeah, because because there is a scenario where everybody wins. And that's like, and all that takes is just, and that's where really relationships are so important. And I've been at Hercules for almost 11 years. I'm not going anywhere. And it's one of these things where I've invested so much of like my time here just building relationships, and I would never want to do anything to hurt these relationships that we've worked so hard to build over the years. And that can happen so quickly when people make quick, rash decisions and not collaborative with the ecosystem.
11 years. Wow. And in this day and age, that's you're on quite the tear there. What are like kind of the different parties that you look at in like this ecosystem you play in that you build relationships with? I'd imagine it's the companies, the venture capitalists. Like, how do you balance your time to make sure that you're making inroads with everybody?
It's like, I'd say it's split between the two, split between investors and directly with companies and also with partners as well. And I would consider, I also spend a lot of time with banks and because they're partners to us in the ecosystem. And
you've been on this incredible ride in venture lending, but looking at your profile, you actually started in sales, right?
Yes.
What was the first sales job you worked?
It was right out of college. I worked at this Boston-based headhunter firm that had an office in San Francisco, where I was placing software engineers and software architects and this was like back in 2001. I'm definitely dating myself here after college. And that was my first job. And it was only meant to be a temporary thing because I already had a job at Accenture that I was going to, so I was supposed to do management consulting.
Did they know that?
They didn't know that, no. But at that point in time, I think I had like 3 months left before, after graduating and,
Yeah.
and before starting my job. And I was like living at home, going absolutely nuts, with my parents. I'm like, I need to get out of the house and, and I'm broke, also make some money. So I'm like, what the heck? So I think I found it in like the newspaper. And so that was my first sales. It was my first sales job that actually didn't pay me any commission, ironically. And it was placing software engineers and architects. And then September 11th happened. And also like the market crashed. And then that's really where I learned to sell like literally ice to Eskimos, because companies were letting go engineers it was insane. Like everybody was cutting. And that's where I had to really shift how I sold and my value proposition to prospective hiring managers. And so instead, typically what would happen is you would call like a VP of engineering or whoever the hiring engineering leader was, and then you try to get them to see some of your candidates. But then now like hiring really wasn't happening. It was not robust, let's say, in that period of time. And so instead what I did was I looked for really unique engineers. And then I got them to sit down and meet with me. So I looked for engineers that graduated from like top engineering schools with PhDs with specific engineering experience. So at that time it was like Java J2EE, or it was like people that had like PhD in computer science and bio. So they were like doing like bioinformatics from like, but only like top tier schools, where they were like these like purple squirrel unicorns that were running, that were in the bear, that were not looking. And so instead I got them to be open to the idea of interviewing with a company. And then I went to market and I pitched them. And I called companies that I thought that they would be a good fit for. So that's what I did. This was back in 2000. So that was like an interesting kind of part of my career. But that's how I started in sales. What's
crazy about that is you looked at it and you said, I don't like the demand here, so I'm going to change the supply side of the equation.
Yeah, it was a slog though, but getting cussed out and being told you're an idiot for like calling and getting hung up on, it makes everything else seem a lot easier after that.
Well, what's a sales skill that has made you a better investor? It sounds like you grow some thick skin from that.
It's consistency and just resilience, because it's hard and we go through so many cycles as just as business leaders, right? I mean, where you're and ultimately, like once you get to a senior role, like you're always selling. If you manage a team, like you're selling people on like why they should be on your team versus go working somewhere else. You're selling internally on why you're selling internally up, down, left, and right, and then you also have to sell externally. But I think my background in sales, it's also been that I'm constantly focused on pipeline development and relationship building. And that's just like the pure sales DNA that I have, as opposed to just like relying on my existing relationships. I still cold call consistently.
Really? You do? Yeah. You're a managing director and you still cold call?
Oh my goodness. Absolutely. I still cold call. I still cold email. I actually block it out on my calendar throughout the week. Uninterrupted time.
Are you just worried you're going to lose your edge? You're like, I need somebody to hang up on me.
Perhaps. Yeah. I mean, it's
I love this. This is awesome.
Because we live in such a dynamic world within, venture tech. Like you always have to be sourcing.
I like what you said about like the higher up you get, the more the job is sales, because even I started at PwC out of college, and I remember there was this one conversation where we had the managing director in the room, and it was the other team that we were helping from this auto company in Detroit. And then I was like, I think he's like trying to sell him on work right now, which is weird because like we're doing a project for him already. And then like it clicked after. I was like, oh, he's in a sales job. Like he has a quota. I didn't know it was called a quota back then, but like he's a managing director doing sales. And I was like, I thought he was an accounting guy. This is kind of weird.
Yes, it's so true. And it's so funny because when I was interviewing back in college, I did an internship at Deloitte.
Yeah.
And I remember, and it was not for me in accounting. And I remember talking to the partner that convinced me to like do the internship. I was like, so when do I get to sell projects to, when do I get to find new clients for Deloitte? And he's like, oh, that's what happens when you get more senior. And like, that's a partner's role, is to get new clients. And I was always thinking like, oh gosh, this is going to be a long road to get to sell.
Well, I think that's actually what scared me getting into like a C-suite position, getting to become a CFO, because you start to realize like you may get pulled into deals, especially if you're trying to sell to a financial client. Like, and you're always selling to employees, whether they're current, prospective employees, and you're selling to the market. Like more and more of it is storytelling. And
yes,
as someone who's naturally more of an introvert, I have no idea why I have a podcast. Like that to me was scarier than the numbers.
How are you an introvert? I don't believe that, CJ.
Oh, ask any of my family members. They're like, we can't get 3 words out of you at the dinner table.
Really?
Yeah. I don't know. It's a podcast. It's talking business. It's more natural to me. Yeah.
You don't strike me as an introvert. But like you bring up such a good point around CFOs and storytelling. It makes all the difference when we're working with companies. And I mean, and then of course, if you want to evolve into becoming a public company CFO, I mean, you are pitching. You are absolutely selling right there with the CEO as their partner. And it's such an important critical skill, as the role of the CFO has really expanded in its scope within organizations.
Do any CFOs that you've interacted with strike you as like impeccable storytellers? Who are the best storytellers out of the CFOs that you've met?
Oh my goodness, you're going to put me on the spot here, because there are a number, but I think Sarah Spoya from Pulley is absolutely phenomenal.
She rocks.
Naeem Isak, he's a CFO
of Checker. Yeah, he's the man. He came on the pod.
He's a fantastic storyteller. And so it's the ability to, but I think what also kind of sets them apart is that from a technical perspective, like they've got some serious chops from the financial side. They know every metric in their business, really strong from an operational perspective, but can also sell the hell out of their companies.
I like that. I feel like selling capital can be tricky because like at the end of the day, it is just money, right? And I don't mean like just money, like anybody can get it. You still have to have good metrics and stuff, but like money is a commodity when you think about that. Like it's not differentiated. Money be green. Like how have you thought about in your career at the intersection of financing and sales, like how to differentiate selling a commodity essentially?
So it's so funny that you say that, because I don't feel like it's that I'm selling a commodity. So I think a lot of it's like people and who people actually want to work with, and what a company actually needs at that point in time that goes above just capital. And so I've definitely made a ton of introductions for prospective portfolio companies, for existing portfolio companies, for investors, within our ecosystem. That's a big part of what I do, is actually making introductions, which have since resulted in multiple deals, multiple like CFO hires within specific companies, where it's not just providing the capital, but it's providing additional value. And my specific one, or like the superpower, is the connectivity with people and helping make those connections that are going to be helpful to my portfolio companies.
I definitely had a sense that was your superpower. You seem to know everybody.
No, I don't know everybody, but
all the great CFOs, I feel like you have a link to many of them. And I mean that in a way that's like, I'm very appreciative of it, because it's hard to make inroads with those type of people because they get pitched on stuff all day, and you have to like find an angle that you can help them with something, they can help you with something. Like it's not like in the industry we play in, it's extremely easy to get inroads and genuine inroads with a lot of these people.
It's interesting because I see it more of like, I'm just grateful for the people that I get to meet. Yeah. And just for some reason, sitting here and offering debt to companies, it gives me like that opportunity to actually get to know these people. And I genuinely like love learning about people. and businesses, like that's what makes this job so fun. And then just having like the conviction that I legit have like the best freaking team here, like that I'm working with, and like the strongest balance sheet in what we do. Like I just have a tremendous amount of conviction, and it's super fun to come to work every day.
Well, speaking of having fun, you host a great podcast. Have there been any conversations that genuinely change your perspective on either finance or leadership?
Oh, that's a great question. Yeah, I mean, there's so many incredible guests that we've had on. I mean, each person's story is so different from Adriel. I don't know if Adriel Lares. Ironically, I mean, he's like a really strong kind of like iconic tech CFO. I had the opportunity to work with him at when he was the CFO of Fastly, but now he's the CFO of the Chelsea Football Club in London.
That's badass.
It's so cool, right? And I mean, what it comes down to is just the opportunity to hear about his story as like being like a Mexican immigrant here in the States, and how he has worked his ass off and succeeded, and is also owns a phenomenal like winery in Napa, but he's just like a really good person. So I mean, I wouldn't ask people to be on the podcast that I don't just like genuinely love and respect for their professional capabilities, but just as like amazing human beings that are friends.
I feel like having a podcast has been like a huge accelerant to my career, because I get to talk to like really smart people like you who have all these incredible stories. And if there wasn't like a platform to have a conversation, it would be hard to like get them on the phone. It's like I shock myself all the time with like the people who agree to come on this. So with that, I want to thank you for coming on. I've had a blast, and thanks for sharing all your insights.
Thanks, CJ. You're so awesome at what you do. Like I aspire to be a host like you. I mean, you're so good at this. I love listening to your podcast.
Thank you. I'm making it up on the fly. It's me, my dog, and a bag of treats to keep him quiet. So hopefully I don't mess this whole thing up.
Thanks, CJ.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.